As mentioned previously, SEBI, Securities and Exchange Board of India, categorizes mutual funds in India into 5 distinct categories. So far, we have discussed equity mutual funds, debt mutual funds, and hybrid mutual funds. In this episode, we will delve into the remaining 2 important types of mutual funds: solution-oriented funds and other mutual funds. The quote, "If you fail to plan, you are planning to fail," as coined by Benjamin Franklin, imparts a vital lesson. Effective planning is essential to achieving our life goals. Whether it's preparing for your children's education, planning for their weddings, or securing your retirement, the earlier you devise a plan, the more advantageous it proves to be. This is where solution-oriented mutual funds come into play. Solution-oriented mutual funds offer a convenient avenue for your financial planning, aiding you in realizing your long-term aspirations. As the name suggests, they are specifically crafted to assist you in meeting future significant expenses, such as funding your child's education, financing their wedding, building a retirement corpus, and more. Previously, these schemes were grouped under equity mutual funds or balanced funds. However, SEBI has recently established a distinct category for them. This separate classification grants fund managers the flexibility to construct portfolios that align precisely with investors' financial objectives, risk tolerance, and return expectations. It enables them to design portfolios that cater to these specific requirements. Consequently, such mutual funds offer a wide array of choices, providing diverse portfolios that harmonize with your particular financial goals. There are various types of solution-oriented funds provided by different asset management companies, AMCs. But 2 of the most common types are retirement planning mutual funds and children's gift mutual funds. 1. Retirement planning mutual fund. These funds invest in equity or debt funds based on the investor's risk profile and goals. They typically have a mandatory lock-in period of 5 years, meaning investors cannot withdraw their investment before this period. This lock-in period is in place to encourage investors to stay committed to their retirement goals. Initially, these funds may invest in riskier assets, as investors can take more risk at the beginning of their investment journey. However, as investors approach their retirement age, the fund gradually shifts towards safer and more stable assets. Once an investor reaches their retirement age, they can either withdraw their entire investment at once or choose regular intervals of withdrawals, similar to receiving a pension. 2. Children's gift mutual fund. It often feels like inflation and school fees are racing to impact the average person's finances. In such situations, it becomes crucial to plan for a child's future as early as possible. Many parents start investing in this mutual fund even before their children are born. This fund can also be used for other long-term goals, such as children's weddings or other important expenses. 3. Other mutual funds. This category includes 2 types of funds: index funds and fund of funds. Index funds offer more diversification compared to other mutual funds, as their portfolio is designed to match market indexes like BSE Sensex or Nifty 50. They are also known as passive funds because they always follow a specific index. Due to this tracking nature, their expense ratio is relatively low. Index funds are considered quite favorable for long-term investors because over the past 10 years, they have provided returns of around 10 to 12% to investors. However, they are not considered suitable for short-term investors due to the continuous market fluctuations, which can lead to losses for them. For instance, during the 2008 financial crisis, Nifty 50 experienced a nearly 50% drop, causing significant losses for short-term investors. Nevertheless, in just a few years, it bounced back and even doubled in value. This example helps us understand that short-term investors should stay away from index funds, while long-term investors can have faith in them as they have the potential to provide excellent returns over the long run. A fund of funds is a specific type of mutual fund that channels its investments into other mutual funds. This unique approach allows investors to access even hedge funds. The fund of funds manager strategically allocates resources into the top-performing Indian mutual funds as well as international counterparts. This strategy takes diversification to a higher level, shielding your investments from market shocks in India. Some notable examples of fund of funds encompasses gold funds, multi-manager fund of funds, and international fund of funds. Gold funds, as the name implies, primarily invest in gold securities and companies involved in gold trading. The multi-manager fund of funds is the most common variant wherein the fund invests in mutual funds with a track record of delivering superior returns, managed by seasoned fund managers. The international fund of funds, on the other hand, directs investments into mutual funds in foreign markets. Often, foreign markets outperform the Indian market, making this a prudent choice. For instance, following the COVID pandemic, stocks of American tech companies soared to unprecedented heights, delivering substantial profits to investors. Before considering an investment in a fund of funds, it's crucial to bear in mind two key factors. Firstly, the expense ratio of these funds is generally higher compared to other mutual funds due to the elevated management costs. Secondly, these funds are better suited for long-term investments, potentially making them less liquid.